Japan's recent decision to dump a staggering $119.3 billion in US Treasury bonds is not just a routine sell-off. It's a monumental event that has sent shockwaves through global financial markets. In a move of seismic proportions, Japan has triggered a $1.7 trillion market loss, marking a dramatic shift in the balance of financial power. The immediate fallout has been swift and unsettling, with the US economy grappling with the consequences. But this isn't just about numbers on a screen. It's about a profound shift in how the world perceives America's financial stability. The response from Trump? Public denials and feigned confidence, while behind closed doors panic is taking hold, with a desperate scramble to manage the fallout. This is more than a financial crisis. It's the beginning of a global reordering that could fundamentally alter America's role in the world's economy. So what exactly is going on here? Why is a country like Japan, long seen as a loyal financial ally to the United States, suddenly pulling the rug out from under the US dollar? More critically, could this be the moment when the world begins to lose trust in the dollar, the bedrock of global finance for decades? To understand this, we need to look beyond the numbers and examine the shifting dynamics at play. Japan, which for decades has quietly amassed US debt, is no rogue actor in the financial world. It's the fourth largest economy globally, and its influence cannot be underestimated. But the Japan we know today is not the same Japan of a few years ago. As recently as January 2025, Japan held the largest foreign debt portfolio in the US. But now, in what can only be described as a dramatic about-face, Japan slashed its holdings of US Treasury bonds by $119.3 billion, the largest quarterly drop since 2012. And the ripple effects of this decision are being felt far beyond Wall Street. For years, Japan has been one of the most dependable buyers of US debt. But the landscape has changed. The Bank of Japan attributed its move to domestic yield curve adjustments. But there's growing evidence that this is only a surface explanation for a far more strategic shift. Economists, including HSBC's Frederick Niemann, are arguing that Japan's actions reflect a growing hedging strategy, one designed to prepare for future instability in US fiscal policy. In other words, Japan is getting nervous about the future of the US economy, and it's taking steps to protect itself. This is not just about monetary policy, it's about a much larger and more concerning trend, a loss of faith in the long-term stability of the US financial system. Japan's decision wasn't made in a vacuum. Over the past few years, tensions between the US and Japan have been quietly simmering. In 2024, for example, the US imposed a 25% tariff on Japanese electric vehicles, accusing Japan of unfair subsidies and national security threats. The move stunned Tokyo and prompted an immediate backlash. Nissan's CEO Makoto Ucha publicly condemned the tariffs, calling them a direct attack on innovation and integrated supply chains. Japan, with its world-leading electric vehicle technology and dominance in the battery sector, wasn't going to take this lightly. In fact, the tariffs were a catalyst for a much larger strategic response from Japan. It wasn't just about cars or auto parts. It was about sending a message to Washington. Japan's financial retaliation didn't begin with a slap in the face to the automotive industry. It began in the bond market. By selling off US Treasuries, Japan wasn't just taking its money out of US debt. It was delivering a powerful warning to Washington. Japan was no longer willing to passively support the US financial system. This wasn't just economic strategy, it was a geopolitical maneuver. By the first quarter of 2025, Japan had secured a dominant position in the global electric vehicle market, controlling over 48% of solid-state battery patents, according to the World Intellectual Property Organization. Meanwhile, US automakers like Ford and GM were still struggling with battery supply issues, exacerbated by rising costs from Chinese graphite restrictions. Japan now had an economic leverage it had never had before, and it wasn't afraid to use it. The world's most technologically advanced car makers were on the brink of making a huge leap forward with solid-state batteries, and Japan was leading the charge. This gave Japan bargaining power in trade negotiations that it had never had before, creating a perfect storm for Washington's economy. Japan's actions have sent shockwaves through global financial markets. When a major creditor like Japan decides to exit the US Treasury market, it doesn't just create a gap, it destabilizes the very foundation of the global financial system. In February 2025, US Treasury bond yields surged to 4.89%, their highest level since 2007, as foreign demand for US debt waned. The Congressional Budget Office warned that this increase in yields could raise US debt servicing costs by $270 billion annually by 2027. The result? A tightening of financial conditions for US households and businesses. But the damage didn't stop there. The dollar index plunged by 2.1% in just 2 weeks, as central banks from South Korea to the UAE began to reduce their dollar reserves. And it wasn't just about the dollar's decline. Investor confidence was starting to erode. The global implications are staggering. Higher borrowing costs for Americans, a weakening dollar, and the increasing uncertainty surrounding U.S. fiscal policy have all contributed to growing fears among foreign investors. Is U.S. debt still the ultimate safe haven? With Japan's sell-off and other signs of a growing global movement away from the dollar, the answer is increasingly unclear. This is more than just a hiccup in the market. It's a tectonic shift in the foundations of the global financial system. Japan's $119 billion sell-off is just one piece of a much larger puzzle. Since 2022, the dollar's share of global reserves has dropped from 59% to 54%, according to IMF data released in March 2025. The trends are clear. Countries like Malaysia, Brazil, and Saudi Arabia have been diversifying their reserves, investing in non-dollar assets such as the Chinese yuan and gold. In Southeast Asia, China's digital yuan is now being used in 5% of cross-border settlements, a figure that is expected to grow rapidly. Meanwhile, India's rupee has found its way into oil contracts with countries like Iran and Russia, further signaling the decline of the dollar's dominance. Japan's actions have accelerated this trend, and the global financial system is starting to fracture. China's digital yuan now accounts for a growing share of international trade, and the BRICS countries, Brazil, Russia, India, China, and South Africa, are preparing to launch their own alternative payment system outside of the SWIFT network by July 2025. These moves are not isolated incidents. They are part of a much larger shift away from the US-dominated financial system, and Japan's exit from the US Treasury market is a key turning point. The stakes have never been higher. Between February 3rd and 6th, 2025, the U.S. stock market lost $1.7 trillion in market capitalization, with the S&P 500 falling 5.4% in just 3 days. The catalyst for this plunge was a combination of Japan's Treasury sell-off, rising bond yields, and worsening trade tensions. But the situation worsened when Trump's administration announced plans for a new round of retaliatory tariffs, this time on Japanese electronics and South Korean semiconductors, raising the very real fear of an Asia-wide trade war. BlackRock analysts have warned that the current climate of policy unpredictability is now the primary driver of market risk. Meanwhile, Moody's downgraded its outlook on the U.S., citing ballooning deficits and escalating geopolitical instability. It's debatable whether Trump directly caused the market crash, but the results were clear. The world is losing confidence in the stability of the U.S. economy. What once seemed like manageable noise, a series of aggressive protectionist moves and trade conflicts, has now been redefined as systemic risk. The global economy is no longer able to ignore the growing instability in Washington. The world is beginning to question whether America's financial system can remain the world's anchor. As these events unfold, the question isn't if a new global financial system is emerging, it's how fast the old one is falling apart. With Japan pulling away from U.S. Treasury bonds, central banks diversifying into other currencies, and trade conflicts escalating, the future of the U.S. dollar is hanging in the balance. America's financial system has been the backbone of the global economy for decades, but the cracks are becoming too visible to ignore. The old order is eroding faster than anyone could have predicted, and the world is now grappling with the reality that the financial system may no longer be as stable as it once was. The question remains, what comes next? The world is watching closely, and the next chapter in this financial saga may be one that changes everything.